Hey guys, this is Justin. On April 30th, we interviewed 24 guests in a 12-hour live stream to raise money for Susan G. Komen in conjunction with our friends at Spot Gamma. Our guests were some of the smartest market experts we know, covering topics ranging from value investing to factor investing to macro and options. We are releasing each of the interviews in pairs of 2 over the week following the live stream to bring our guests' insights to our audience in shorter videos and to continue to raise money for a great cause. If you are able to, we encourage you to donate using the link provided alongside each video. As always, thank you for listening. Please enjoy our conversations with Jim O'Shaughnessy and Perth Tolle.
So as a reminder, Susan G. Komen, how to give, look at the page around you. There is a donation button. You want to click it, whether you're on YouTube or LinkedIn or Twitter, or wherever you're watching this. And without further ado, founder O'Shaughnessy Asset Management, O'Shaughnessy Ventures, author What Works on Wall Street. I didn't make it back to the shelf back behind me where I have my copy, of course. Jim O'Shaughnessy, thanks for coming on today.
Oh, thanks for having me.
We've got a million things we could talk about, but perhaps I'm getting delirious. Perhaps the coffee is wearing off. I have not been going since 8 a.m., but I feel like I have almost. When I want to talk to you about kind of like the areas that I see you focusing on, because I think this is so interesting. You did the public markets thing. Comment on that. I'm not saying you don't do the public markets thing, but you had a really unique way to think about public markets. Why was that an insight then that's a different insight today?
Well, back then, I just was lucky enough to be born at the right time, to be really honest. If Ben Graham had had access to huge databases and computers like I did, he would have written What Works on Wall Street. So I have no illusions about the fact that super smart people, had they had the tools, would have done all of that homework. And I was just lucky enough to be able to be the first to kind of put 2 and 2 together, standing on the shoulders of those great early proponents of a more systematized, detailed way of looking at investing. So public markets are huge and massive and liquid and wonderful to invest in. Our particular approach was quantitative, factor-based investing. We basically, I used to joke, would you go to a doctor who said, I just got these little yellow pills in and I'm going to wing it and I'm going to give them to you. No, you're going to run for the hills, right? But what you would like to go to a doctor who says, these pills are perfect for what you have.
Wait, what color are they though? What color? Are they yellow?
Not, they're still yellow. Yeah.
Oh, they have a stripe though this time, right?
But you want to see all the double-blind tests, right, that prove the efficacy of that particular treatment. And that's kind of what we're trying to do with factor investing, which has obviously done pretty well since I started in it back in the dark ages of the 80s.
Do you feel like back in the dark ages when you're doing this, I've always wanted to ask you this question. Do you feel like back in the dark ages, it was just because not everybody had access to the data? Like people would have been smarter if more people troubled to gather the data?
So that's a great question. I think about that a lot. When I started out, I really started out overhearing a conversation between my dad and uncle. And this was in like the late 1970s. They were talking about IBM, I think. And the entire argument was about the CEO or about what new products IBM had coming. And I kind of thought, I'd rather know how much I have to pay for every dollar of earnings or sales and that type of hard data. So I think it took people a while. There's always cultural lag. When something comes on the scene, it's different, like factor investing, et cetera, for people to, get tuned into it. But yeah, I suspect with the explosion that you've seen and all the tools for individual investors who don't want to hire managers like myself. I definitely think that the availability of data, the availability of tools, switched on people definitely would have ultimately gotten involved. Like I said, I was just lucky to be a little bit older than those folks.
Okay, but were you lucky too then to hear conversations like that between your dad and your uncle? Because it feels like this is the evolution. I'm not saying you're not taking this data-driven approach to some of the stuff you're doing in the venture space, but like as you've evolved, You learned some of this soft data to look for too. You learned how to think forward in a way that traditional old school value investing, it's a different type of forward looking that it seems like you're all about today.
Yeah. And I call that imbued or saturated intuition. When you see a pattern repeat itself time after time after time, you start being clued in maybe a little bit earlier, just because you've seen it happen so many times. And so, even though we ran all of our public market investing based on quantitative models that we did not override, 35 plus years in the public markets, you see the same thing happening again and again and again. And that informs your intuitive side, right? That informs what we're doing now, which is much different. Quantitative tools can be helpful, but they certainly are not the final decision maker in the venture investing we're doing today.
I'm sure no one has asked this question today. What is intuition?
So it's interesting that you asked me that. We are looking at doing a project with the famous, I guess, heretic scientist Rupert Sheldrake, who's done an amazing amount of actual scientific work looking at what is intuition, right? The hairs on the back of your neck. We've all had that experience, right? When somebody's staring at you from somewhere and you don't see them staring, but the hairs on the back of your neck stand up. I find that very interesting. And so what I'm interested in is, can we adequately define it? If we can adequately define it, can we improve it? If we can improve it, can we do tests to see how much we're improving it and in what ways? So I think that intuition, back to my earlier statement, really is kind of seeing the same type of thing occur again and again and again. And you just get so used to that pattern that you might see it out of the corner of your eye a little faster. I'm not saying that you're going to see it a lot faster, but a little faster. And so I'm fascinated with, if that is true, can we kind of get some empirical numbers around that? And more importantly, can we build an app that would help people improve their intuition? That's something that we're actually looking at doing right now.
Very cool. Have you come across, do you know Natalie Nixon or her work at all? Did you run across the Creativity Leap?
Yes, I have run across her work. I don't know her personally, but yes, very interesting work.
She frames it because one of my favorite definitions of this, and she says you have to toggle back and forth between wonder and rigor.
Yes. Oh, I love that. That is so true. Because you really, when I talk to a lot of people, I do find that people tend to be on one side or the other. People tend to be just rigor, or, just go with the flow, man. Just, it's all wonder. And I'm just really seeking, and a lot of actually what we're doing is seeking to unite those two. I think that there's truth to both sides of the argument. And obviously I come from the rigor side, but I'm really interested in the wonder side as well. And so trying to holistically build them in repeatable ways, that's clearly important to us in investing. That really attracts me.
And it's really curious because in that toggle between the two, like some of the stuff I see you focusing on with O'Shaughnessy Ventures, the adventures, the films, the media, these are all places where you seem to be asking this question over and over again about where does the wonder actually fold in with the rigor? Is that the way you see it?
Well, maybe not that specifically in films or media. Listen, O'Shaughnessy Ventures is focusing on all the things that I've loved all of my life, but didn't have the time available to focus on those other things. So films, for example, I have nothing against Hollywood. I love movies. I've always loved movies, but I want to see movies that are inspirational again. Where are the Rudies of today? Yeah, and if you haven't seen Rudy, that's about the kid who goes to Notre Dame and as
a lifer in a Penn State household who was taught every Thanksgiving,
right,
to hate Notre Dame. I give that movie a pass. It's fine. I can't
Well,
hate Rudy.
hey. So maybe we'll make one about Penn State. One of
Yeah, we
my,
got to
one
get
of
over
my,
some things. We're
well,
slowly being redeemed, but that's a whole other
yeah,
story.
that's true. That's
Yeah.
true. But we want to make stories that inspire again. We want to focus documentaries on things that are super interesting, but also inspirational. We're currently making a documentary about Dr. David Roney, whose life is like an incredibly inspirational tale. And we just want to see more of those in the world. And we're doing documentaries. We're focusing on things where I say this often, but it's a good shorthand. We are trying to make and look for things to root for as opposed to against. So many people today, it's pretty easy to root against things. I don't like, fill in the blank. And we prefer to find things that we can root for, and we think that will inspire other people as well. Same with media, same with what we're doing with podcasts and Substacks and YouTube. We just think there's a lot of room there. And then we also have Infinite Books debuting, and same sort of thing. It's like I've written 4 books, and the publishing industry, traditional publishing industry, hasn't really changed at all since I wrote my first book back in the early 90s. And we now have the tools and technology to really invert the deal for authors. We think that authors should be getting a lot more of the revenues than they're getting under a traditional publishing agreement. We think that they should have tools like dashboards so they can open their computer every day and say, oh, wow, my book just 5x'd its sales in Omaha. I wonder why. And so we're going to be building all of that into Infinite Books.
And it's so interesting, especially in books and publishing, because these are some of the data questions where you're asking, why is this margin still this way? Why are we counting in the book sale numbers like audio, print, and Kindle all in one place and enshrouding this from the authors making these things? I can't help but feeling like you're bringing some of the rigor to some of these places and going, it's a different type of disruption, the way I feel like you're attacking this.
I think that's right. I think that what we want to do is look at things that fascinate me. So books, films, early stage investing, et cetera, and then bring a little bit of my old quantitative background and just say, wait a minute, why are authors still getting just a fraction of the sales of their books? That doesn't make any economic sense, right? And so if you look across our verticals, you'll also see these are areas where I feel that there's a huge arbitrage ability if you do it right, right? So let's stick with books. The fact that the traditional book publishing industry hasn't really embraced a lot of these changes kind of baffles me, because like you can improve the model for readers, you can improve the model dramatically for authors, you can improve the entire experience. For example, audiobooks. Why aren't audiobooks living things? Why if the author is on a podcast where he or she is particularly great, why isn't that added to the audiobook so that the listener can hear the new of what's going on? How about interview tapes? Like my friend Jimmy Soni has hundreds of hours of interviews with guys like Elon Musk. I'm sure you might have heard of him. And why aren't those on the audiobook? They should be. Why aren't audiobooks published in every language that is spoken today? With AI and with the translation getting better and better and better, that's very conceivable to do right now. And so we just think that there are so many ways to improve the experience for the reader and for the author. And like everything we're focusing on, we do have a rule, which is we are only going to look at opportunities that we feel can be win-win, right? Win-lose, zero-sum opportunities we think are of no interest to us anymore because we don't have to live like that anymore. And so we're just trying to practice what we preach.
Inside of this, because it feels like, how do you make this an investment and not just a hobby? Like, it's one thing to just throw a bunch of money at this and make a bunch of cool stuff, but you're also trying to build businesses here.
Mm-hmm.
How do you think about, like, on the publishing, just on publishing alone, how could you do that and make it profitable? And yes, win-win for everybody consuming the things in the ecosystem. Maybe not such a win for Penguin or somebody, but like, how do you build a business around this and make it competitive?
So I think you build the business by offering much better products, right? And what does that entail if we just stick with books for a minute? Well, a better publisher is one that is better for the author, offers more choices, like I just mentioned, and enumerated for the reader or listener. And given the tools and technology that we have today, it can be a massively profitable enterprise. Let's say, for example, we do a split of 70% of the revenues to the author, 30% to Infinite Books. We are still going to be very, very profitable because we don't have to do it the old fashioned way. It no longer takes a year to print a book. And yet,
Right.
that still seems to be the general rule of thumb. So what we're doing is we're simply looking at inefficiencies and saying, there's a much, much better way to do this part of the process, this part of the process, and this part of the process. And so, it's Schrumpter's creative destruction. It's basically, there's a huge opportunity here. Can't really imagine why the existing players and dominant players in the industry are doing it. But I mean, that's human OS, right? Like GE
Right.
and transistors. Why didn't GE own the transistor market? Because their vacuum tube division was their most profitable. And so it's really, really hard if you're making a boatload of money doing it the old fashioned way and using the old playbook. It takes a lot of gumption to be able to say, you know what? We're just going to tear up that playbook and we're going to do this new one.
And those play all the way forward, right? I think about Blockbuster passing on Netflix and some of the really fun things are.
Exactly. And, we can all feel like we're very clever because everything is obvious in hindsight, right?
Right.
And so, God only knows how many stupid things I passed on that went on to be really great.
That's part of the experience though, right? Like
Of
you
course
have
it
to
is.
pass on.
And it also kind of feeds back to your earlier question about intuition, right? When that happens to you enough, you're kind of like, boy, this looks and smells a lot like that deal that I said no to 15 years. Well, I'll give you a great example. When ETFs were coming out, I got approached by the American Stock Exchange and they said, hey, we'd love to do a suite of what works on Wall Street ETFs. And I'm like, yeah, no, thanks. Don't have time for that.
You guys into your acronyms. Always coming up with a bunch of letters. Alphabet soup.
Exactly true though. And it was like, no, I can't believe it. It's like, I have a friend, a long-term friend who was teasing me about it the other day. He goes, do you ever think about the fact that you said no to the American Stock Exchange when they wanted the whole debut of ETFs to be using what works on Wall Street data? I'm like, yeah, I try not to think about it every day, but it's a great example of, I learned a lot, right? Wow.
Right.
I should have paid much closer attention to that.
When you think about this and just like what surprised you the most? So now that you're actually actively doing it, because it's also another thing to talk about making these private investments or talk about starting to seed these ideas. There's a big difference when you start to do it. What surprised you the most about getting your garden gloves dirty here?
So I think what surprised me the most, and this is probably also due to my longer career as like an empiricist quant, right? What surprised me the most was how important optics and narratives were, especially in seed investing. You often hear people say you've got to get your idea down to an elevator pitch, but I don't know about that because a lot of the best ideas that I've seen are they take too long to do a good elevator pitch around. And so I'm fascinated by the amount that narrative drives seed stage investing. Everyone, it's axiomatic in public investing that, narratives matter and whatnot. But I always believed in public investing that narrative followed price, not the other way around, right? I'll give you a great example. In the early 2000s, one of our more aggressive growth strategies was loading up on tiny steel companies. And like me and my analysts were like looking at this and we're just like, what the heck is going on here?
What
What
broke? Yeah.
steel companies in our growth? And
Right.
then like 9 months later, of course, all of the stories and all the magazines and the journal and everything else, China is building the equivalent of one Boston every month, and they are consuming all of the world's steel. And we're like, oh,
Oh,
that's why
yeah.
the price was going up back then. In seed stage and early stage investing, the stories are much more important in driving interest, I guess. But we try to just look beyond the underlying narrative and just think, okay, is this like really a great idea, or is this just like, I don't know, what's the old saw? If reality differs from the legend, print the legend.
Yeah.
We want to try to overlook and being too credulous around. Wow, this is going to be the best thing since, fill in the blank. It used to be sliced bread.
It used to be sliced bread. Then it was steel companies. Now it's probably something else. I like to say, because I really hate the everybody needs the elevator pitch thing. And so when I'm talking to like my marketing friends or other people, I'm like, you know what elevator pitches are for? They're for people who ride elevators. So unless you're pitching on an elevator, I'm sorry, I don't need an elevator pitch. I don't really ride
Exactly.
elevators that much these days, but
Yeah,
I have
yeah,
the go out to dinner pitch, or I have
yeah.
the walking down the street on my phone while you're, on your treadmill pitch.
That's the good pitch. Walking around, just listening to them, and like we always try to have a a real in depth conversation with potential founders that we're thinking about funding.
Mhm.
Because the other thing that we're noticing here on these early stage investments, like the idea, yeah, of course, the idea's got to be good and appealing to us. But ultimately, the team, it is people that ultimately are going to make or break that particular idea. So that's been really interesting for me because as a quant, we were like, we don't care who the CEO is. It's just numbers. Just give us, we don't even care what the ticker is. Just you can give us numbers and numbers alone. Because obviously you're dealing with a much larger data set, right? And things tend to cancel each other out. When you're specifically looking at things like synthesis schools, for example, we made an investment in that because we thought the idea was great, right? It was Elon Musk's old Ad Astra concept,
Mhm.
but we loved the team and we loved where they saw what their North Star was, which was we can customize learning down to the student because everyone has a different learning style. And what they're doing with AI tutors, for example, they're actually training on their students. And the lesson changes as it learns more and more about the student
A
that they're trying
whole
to
different
teach.
feedback loop. Like that's,
Yeah,
yeah, that's wild. As
very,
a previous
very cool.
knuckleheaded student, like that's probably
Well,
valuable.
exactly. It's very valuable because, the one size fits all, that's dead or dying.
It's like elevator pitches. Why are you doing it
Yeah,
the same? Yeah.
exactly. We're moving from mass customization or mass production to mass customization. And I think that is amazing, not only in education, but in medicine. Right now, there are some incredible, we haven't made a big investment because like biotech, ugh,
Hey,
but,
I hear there's
but
losses there. Like it's not
I've,
all grand slams. I heard a thing
yeah,
about that. Yeah.
there's a
Worse than
few.
venture numbers. Yeah.
But but what's interesting is what is going on. I really believe we are on the cusp of an incredible revolution in healthcare because as we learn more and more about individuals' genomes, as we learn about the ability to create a digital twin of me or you, Matt, and then test those meds on the digital twin, not on us, right? There's a lot of super cool stuff going on right now in medicine and healthcare that, again, stays true to this theme of customization to the, and in this case, patient.
I'm fascinated by this idea. This will be a conversation we'll have to continue at another point about how, like, understanding because you were manually at one point uploading like the data, manual enter into spreadsheets, because here's this data that everybody has access to. We haven't loaded it in the same way to start to understand it. It feels like the next advent of data, now that like you don't have to go build a friggin' server room anymore to do your startup. It's like, oh, no, you talk to AWS? Yeah, it's done. Like 10 minutes on the internet and I have all the servers like I need practically.
Exactly. And
We
that's
have a whole new data set.
yeah, we do. And that's they used to say information is the new oil. I think that clean data sets are really the new high grade crude, if you will. Because you're
West
kind of
Texas
garbage.
Intermediate, light and
There
sweet.
you go.
Yeah.
There you go. But, garbage in, garbage out, right? So if you look at, for example, training a large language model, if you train it on what they call the pile, which is everything that's on the internet, it's going to be cool. It's going to certainly be
Sure.
a lot cooler than a lot of stuff we worked with in the past.
Could be Gomer pile cool.
Exactly. But how about training it on some of the greatest works of the greatest minds of history? How about training it on all of the various philosophers? Or more prosaically, how about just training it on Will and Ariel Durant's The History of Civilization? There are some really, really cool things to train these large language models on that give you very, very different results. And so I'm kind of like, I often am just pinching myself that I'm lucky enough to be alive at this time in human history. It's really, really cool.
Guns, germs, and O'Shaughnessy steel stocks. Look at this. All the growth is here at our disposal. So, standard closing question we're doing for today. What's an interesting thing you see going on right now you think others should be paying attention to? Maybe it's some amalgamation of this. Maybe it's something totally different.
Yeah, no, I think it is kind of the amalgamation of what we've been talking about. I think that we now are at a time where small groups of individuals can create things that just a decade ago took hundreds, maybe even thousands of individuals to do. And connected to that is this idea of what they call smart swarms. In other words, not like the old traditional corporation where, you work for it for 25 years, you got your gold watch, you always work with the same people, et cetera, et cetera. Smart swarms are where people who have a particular interest all come together, work on a project, and then kind of dissipate. The project gets done. It often gets done a lot faster and in a much cooler way. But yeah, the tools and tech available to all of us now are like incredible. And I think that we're only going to see more and more of this happening. And that's where I would keep an eye out, because that is where a lot of cool stuff is going to be happening.
So because we're not totally out of time yet, does that mean like in the smart swarm thing, we're not building a hive, to keep using the metaphor here, that has to like scale? Like I don't need the next Airbnb, or I don't need the next Uber. We could come together, solve a problem, integrate it into the broader network, and just move on to other things. Like we don't have to wait for the golden watch. I think you just repackage why I don't wear a watch in like the greatest way ever, by the way.
I don't have one on either.
Right.
I think so. I think that the idea of, cognitive diversity is really important. And
Right.
that's a big part of smart swarms as well. There are people who think very differently than I do or you do, and adding them to that type of team can be very, very helpful for getting the project going faster, better, building something that is going to last longer. But the idea that they don't have to stick around, they don't have to learn to hate the HR department. They can move on. I think that the time of people being able to have kind of like multiple careers at the same time is at hand.
Yeah. /careers. Here we go. Jim, I want to thank you so much for your time today. This has been an absolute blast.
It's been fun for me too, Matt, and have another cup of coffee, and good luck on staying coherent.
We're going to keep it coherent. We're going to keep the donations to Susan G. Komen flowing. Go ahead. I think there's a red button somewhere on your screen. We're going to issue in the next crew of guests any second now.
Thank you, Matt. Great to see you. And
You
great
too, Jim.
cause. I will be contributing.
Fantastic.
Cheers.
Thank you.
Bye.
Cheers.
Just a reminder for all these interviews, we're here today for Susan G. Komen. If you're watching us on YouTube, there's a donate button.
If you're on desktop, it's I think to the right of the video. And if you're on mobile, it's below the video. If you're watching us on Twitter or if on LinkedIn, you can go to YouTube to donate. If you've gotten any value out of what we're doing today, we really appreciate it. It's a great cause. And we'd love to raise as much money as possible. And with that, we welcome Perth Tolle. Perth is the founder of Life and Liberty Indexes. Perth has pretty much taken an ETF product and thrown it on her back from nothing and created it into a massive product. And it's a really cool story. And we're going to talk about that today as we go on. So thank you, Perth, for coming on with us.
Thanks so much for having me. And just on that, I know I always say this and it gets maybe old, but it's not just on my back. You guys shared your platform with me when we, were very small. And so did Bill, like a lot of other people. We have great partners in ETF Architect. So I credit all of the ETF community for supporting us the whole time.
And Wes should probably thank you for the ETF Architect thing as well, because you were the first, right?
He thanks me sometimes.
So to start, I want to take a step back though and just talk about kind of how you got here. So you grew up in China, right?
Yes.
Yeah, and how did that
experience? I was born in
experience?
Beijing, and I came here when I was 9, and then I went back and lived in Hong Kong after college.
How did that experience sort of get you to where you are today, starting a Freedom Emerging Market Index?
Yeah, so having grown up in both countries, experienced the changes that happened in China during the last 3 or 4 decades, and then going back after college around 2003 and 2004. At a time when, the China business was still very exciting and just everybody wanted a piece of it, in Hong Kong, at least. I remember, going to Bloomberg offices in Hong Kong at the time. And, their recruiters were telling us that, one of the perks of working there is you get free Mandarin lessons at lunch, right? I mean, we all know Bloomberg has great perks, but that was like the Hong Kong office, the Hong Kong bureau, one of their perks. So at that time, China was a very exciting market, but my experience growing up, my formative years here in the U.S. and then going to live in Hong Kong for a while and traveling to Shenzhen, Beijing, Shanghai, I saw the difference that freedom made in my life and how these policies impact markets in, China market versus Hong Kong market at the time versus the U.S. I know that gap is closing over there, but for example, I had a friend whose name, we called her Maggie, and I think I've told this story before. She doesn't exist on paper. She was the same as me in every other way. Same age, everything else the same, doesn't exist on paper. No birth certificate, no school records, no social security benefits, because she was born the second child. And so because of the one-child policy, there's 30 million missing women in my generation, causing a massive demographic time bomb, which is going off now, and will continue to for a while. So these policies, I realize, have a huge impact on the future of a country and an economy. So that's when the seed was planted. But it's not till after 10 years after I was working at Fidelity here in the US that we ended up here with the ETF.
Go back there for a second, because you finish school, you go back to Hong Kong. And then you come back here.
Yes.
That move back, when you came back to go work at Fidelity or wherever you decide to go work first, what triggers that decision at that point in life for you?
Yeah. So I followed family back to Hong Kong. So basically, my dad wasn't around when I was growing up, didn't know him at all. And I found him, and he happened to be I found him. He had a house in California. I found him at that house.
Facebook find him?
Actually, my mom went back to China and visited his parents before they passed away. And they gave her the address to his house in California. It was in Danville, California. So it was the summer before I was about to start law school. And I was trying to schmooze my way into UC Davis. And I MapQuested, if you guys remember MapQuest. I MapQuested this address that I had in my head. I actually went up to the wrong house. This house had a green Range Rover parked in front of it. And I was like, this does not look right. This doesn't seem like my
Dad did okay.
Not what I envisioned. Very tall, very blonde lady answered the door, but she's like, hey, there's an Asian family that lives across the street, but they're only here a couple weeks out of the year. They live in Hong Kong. And that's how I found my dad. And he was like, "What are you doing with your life?" I said, "Going to law school." He's like, "No, you're coming to Hong Kong to live with me." So I went to Hong Kong to follow my dad, who I always looked for. Um, that didn't, there's a reason why he wasn't in my life. That didn't work out for very long. And I came back for family, for those reasons. I basically gave up on Hong Kong. I didn't have a work visa. I had given up law school to go there. And I couldn't work legally, and it just wasn't sustainable. So I was only there for about a year. And then I came back, not to work at Fidelity, but after I came back, I ended up working at Fidelity.
So I think it's so interesting because I think it feels like if you don't have these types of formative experiences, I feel like all this had to shape the way that you started to approach this thing of how you think about the Freedom Fund and all the stuff that you did. Am I reading too deeply into this?
No, you're not at all. And I'm glad you're talking about that, because I've never talked about this on, what I just told you, that story, on any podcast before.
Okay.
But
that's
we're
crazy.
raising money for charity here, so we can
Yeah.
say anything. So yeah, no, I think I'm really grateful for all those experiences, right? Like, if that hadn't happened, and now we have our own kids, and our kids have more response sometimes, in my opinion, maybe more responsible parents than I had. Sorry to my parents if they're listening, but and I wonder, do they have it too easy? Like, are they going to have, like, how are they going to learn anything? They need to be more hard, So yeah, I do wonder about that. But as far as like the China experience, absolutely that colors how I invest. Absolutely, it colored how I came to do this. And at the time that I started this, it wasn't just my experience. It was also, I had clients. I worked in the LA and Houston markets at Fidelity for a total of 10 years. And I had clients who, were from Russia, who said, literally, their words, "I don't want to invest in Russia because it's like funding terrorism." And I felt that way about China, because in China, the companies there, don't have, they can't put their own interest in the interest of their stakeholders, like their customers and shareholders, first. They have to put the interest of the state first. So if the state comes and wants something that is detrimental to your customers, they have no choice but to give it to them. And so, and also due to laws regarding like civil military fusion, opaqueness regarding ownership structures, we really don't know what we're funding when we're investing over there. So, so for that reason, I think, it's difficult for me to invest in the emerging markets if we didn't have something like the freedom weighted strategy.
Can you walk us through the idea when you came up with the idea of a freedom index, and how sort of you took that and started thinking about implementing it in the real world?
Yeah. So, with the rise of, I was an advisor at Fidelity, and with the rise of indexing and ETFs, at the time, I was also married to someone who was studying for the CFA. So he was going through, indexing and that portion of the exam.
Really interesting
So,
dinner table conversation is
yes.
what you're saying.
So
Yeah, fascinating.
actually,
right.
it eventually just came from that. And, after I had my child, I ended up leaving Fidelity to be a stay-at-home mom and so I started thinking more about doing this full time at that time. And, it took a long time. I was an advisor. I was on the, kind of buy side of this, and now I'm on the other side, and it's been interesting. So, I think for someone who has, a finance background, people have asked me, like, why didn't you go into government to do something like this, right? Somebody asked me that yesterday, and I think I'm grateful that I was in a space where there was a need that my skills could meet. So, there was nothing that existed like this. Like if I wanted to invest in this way, like express my belief that freer countries will do better over time, that countries with higher, human rights protections and property rights protections will do better over time. Stronger institutions, stronger rule of law, stronger individual and investor protections matter. I could not have invested in this way in the emerging market space before we existed here. So the fact that like this product didn't exist, and I felt that it needed to exist, and I was in the space where I was familiar with how to make it exist. Like, I'm extremely grateful for that. So I think that, we just have to, it seems like a small thing compared to what government does or what maybe NGOs do and nonprofits do. But it's not, if you're in a position to direct assets, whether it's your own or other people's money, that's a position of power and privilege. And we can use that to impact things that happen in the world. And right now, looking at emerging markets like Russia, emerging markets like China, and the axis that they're a part of, right? And causing some of these things to happen in the world, I think, investors are realizing that more and more.
Can you talk about what it took to get it to market? Because I can remember back, I don't know if you remember, like the original Democratized Quant conference that Alpha Architect put on. I remember you were there and you hadn't launched anything yet, and you were talking to everybody you could talk to try to get the product to market.
2017 or 18? Something.
I think it was something like that, yeah.
Yeah.
I kind of wish, by the way, if Wes is listening, I kind of wish that thing would go back to an in-person conference because that thing was a lot of fun.
Yes.
And
we should bring it back in person, maybe in Puerto Rico.
Yeah, actually, you should definitely do that. That'd be a perfect reason to go to Puerto Rico.
Tell him to make room. So yeah, I remember that conference, and I had just the previous year I was shopping. I had the index in 2017, and in 2000, all of 2017, I was shopping it to different issuers, and I talked to literally everyone I could talk to, everyone that would talk to me, and like I talked to iShares, I talked to SSGA, like literally everyone, and everyone said no. It was like 99%. And so like a couple of mid-sized issuers kind of thought about it. And then one of them was like, okay, we'll do it. Here's a deal that we'll give you. And it was like this horrible deal. And I was like, yes, let's do it. And then, and then that happened around Christmas. And then January at the ETF conference, they backed out. And I was absolutely like very depressed. But I knew by then, and by then I had met Rob Arnott, which is a whole different story, and he had committed assets and to a non-existent fund, with credit to him for seeing the vision before anyone else did. And I knew that it would be okay, all that as it was. And so at that point is when I went to the Democratized Quant conference that year. It was March of 2000, I believe, 18. And I asked Wes, like he was still in the garage, the basement at the time. And I was like, yo, after the conference, literally, I was like, do you want to partner on this? Like go 50-50 maybe? And he was like, no, dude, like you need to do this on your own. I'm like, what are you talking about? Like you have 7 PhDs here. I'm literally a single mom.
This is a great Wes impression, just for the record.
Yeah.
Let this show that yo dude was very Ninja Turtle enough.
Yeah.
Good job.
Ninja Turtle is a good way to put it. Yeah, he didn't want to do it. And he was like, I'll teach you how to do it. So he taught me how to do it on my own. He literally like was talking to me every other week, consistently teaching me every step of the way, helping me negotiate contracts with US Bank and stuff. And I'm like, wow. And then by Thanksgiving, I was ready to go out on my own. And we were drafting my exemptive relief, right? And then we're having a conversation. Wes is like, hey, great idea. Brilliant idea. We should do this together. I'm like, did we not already have this conversation? Right? He's like, oh yeah, blah, blah, blah. So yeah, that's how we ended up working together.
I just want to, I want to go back and touch on the Rob Arnott thing, because that's a really cool story. It involves private planes and all kinds of stuff. So I think we should at least cover that before we move on.
Yeah. So Rob Arnott, I met in 2016 at Camp Kotok, and how I got invited to Camp Kotok is, I spoke at a CFA society. This was like my first year trying to do this. I spoke at a CFA society in Tampa. And on the panel was David Kotok, who runs this camp. Excuse me. David Kotok, myself, BlackRock, and Morningstar. I had no idea what I was doing at the time. And after the panel, David Kotok invited me to this camp. And I was like, who does this? Like fishing camp in the middle of the woods, like 5 minutes from Canada. There's no Wi-Fi anywhere. And I was like, and so my friend Christian Magoon at the time, who runs Amplify ETFs, he was like, you should go because Barry Ritholtz goes to this camp. He's like a big fan of Barry's. I was like, okay. So I go to this camp, and you had to take a seaplane to get in there. And I call the day of to get a seaplane. And I'm like, is it too late to get a seaplane? And they're like, no, you can share it with Rob Arnott. I'm like, what? So after I left Fidelity, I called research affiliates. So this was 2014. I called research affiliates. And I said, hey, you guys do non-cap weighted indexing. I do non-cap weighted indexing. Do you want to, partner together? And they were like, no, please go away. And so 2016, they're like, hey, we have a plane with another seat with Rob Arnott. I'm like, okay, great. So I literally am on the seaplane with him for 30 minutes going into Camp Kotag. I intercepted him at the airport. They gave me his, American Airlines flight number. I was like, hey, did they tell you we were going to be riding together? He was like, yeah. So literally had a captive audience, on the seaplane. It's just a two-passenger plane. And and so I asked, I was like, here's what I'm doing. He loved the idea. He loves emerging markets. He loves freedom. I mean, it was like the perfect thing for him. So we fished together for the next 3 days. He ended up getting I was like, do you want to hop on a call with me? I'm trying to raise money for seed. He hops on a call with me after camp. The people that we were on the call with did not commit seed. After the call, he emails me and says, I'll put in $1 million. So he ended up committing seed. The seed did grow between that time and the time of my launch. He ended up also at after I decided to do this on my own at Wes's encouragement, I said I'm going to have to raise capital, and he ended up becoming a capital partner. So he's been an extremely great partner, by the way. He leaves me get all the freedom I need to do, make all the decisions, and he's not involved in the day-to-day, but he's always there if I need advice. So yeah, it's been great. But that he was only at that camp that year. And before that, it was 7 years prior that he was there. And after that, he never went again. And this is not something I could have orchestrated. He literally just went there to pay a bet that he lost to Barry Ritholtz. So I guess we can credit Barry.
Right? Wasn't it cash settlement on that bet? As legend has it.
Yeah, $10,000 bet that he was paying to Barry. So that's not something I could have orchestrated. And that's what I mean is things like that were happening to kind of let me know, hey, you're going to have what you need to do this. And this product needs to exist. So I the whole time that I was launching it, never doubted that the product needed to exist. Even if I failed, I would have regretted it had I not tried. So I was like, I'm going to do it because if I don't try, that's what I'll regret. If I do it and I fail, I won't regret that. So that's, how we ended it there.
Say what the product is. I know we're going to run out of time, and we're going to have to figure out another better way to talk about all this. Yeah, say what it is.
It's a freedom-weighted emerging market strategy. So we use quantitative third-party freedom metrics from think tanks, the Cato Institute and the Fraser Institute. It covers 83 variables of personal and economic freedom. And countries that are the most free country set in the emerging market space are included and weighted according to their freedom levels. So all the information with compliance disclosures are on freedometfs.com and or lifeandlibertyindexes.com.
And say this too, because I think this is super important. You have a fun way of not going by just the market cap weightings of these things. You think very differently than so many other people who are even remotely in this space.
Yeah, so we are 100% freedom weighted. So what that means is the freer countries get a higher weight, less free countries get a lower weight, and it's a cascade. It's not like we assign this, top quartile to this weight, second quartile. It's literally according to how it falls in, how their scores fall in line with their peers. The above average scoring countries are included, and their weights are determined by their composite freedom score based on the 83 variables that are included.
And what's cool about this too is both from a long-term and a short-term perspective. I mean, obviously we know in the short term, Russia was not a great place to be invested. Yeah. China hasn't gone very well. So it's worked out very well in the short term, but I think you have data as well that the freer countries do well over the long term as well, right?
Yeah. So, there's a lot of data that shows the benefits of freedom. The freer countries in general have higher life expectancy, lower infant mortality, higher income per capita, higher GDP growth, lower poverty rates, and their lowest quartile of income, so their poorest people are richer in the freer countries. They have lower gender inequality. So there's all these kind of nebulous benefits to freedom that until now hasn't been able to be kind of tracked by investors. So what we hope to be is a running scorecard for freedom in the investment space starting with the emerging markets, because in the emerging markets where that universe is so rife with autocracy risk. And so there's also a higher freedom premium because of that dispersion between freedom levels in the emerging markets universe. You don't find that dispersion at all in the developed market universe. So that's why we started with the emerging markets. So we hope to be a running scorecard to help, I guess, have a more hard, concrete way to see that freedom does lead to better results, even in markets.
Just as a way to understand how this works, could you maybe give an example of like a country that is in your index right now and one that's not, and maybe some of the major differences between them that would lead to that?
Yeah. So I mean, the poster child example is always China is not in the index, never been in the index. Russia has never been in the index. Saudi Arabia has never been in the index. Taiwan, South Korea, Chile, and Poland have always been in the index, and they're always high. So so a lot of these countries, like Taiwan, is obviously on the forefront of fighting for freedom in their region. When I bring up Taiwan, I always have to address the, what if China invades them question. And, if you look at the Russia invasion of Ukraine, the investment risk lies with the aggressor. So if you're asking that question, look at your, emerging markets fund that is cap weighted and look at the China risk in there. Focus on that, look at that first, and then let's talk about Taiwan. And also, let's try to allocate and support the markets that are supporting freedom in the world, because our dollars do make that impact. So Taiwan it continues to do well. It's always consistently done well, and it's one of those smaller markets that focuses on technology and innovation, but specifically has a very a thriving semiconductor industry, right? So it's kind of become like a critical technology for the world, and that has really helped our fund. Chile is an interesting case. So Chile, in the past several decades, have enjoyed business-friendly policies that have led to a lot of its prosperity. And we've been concerned, investors that are freedom-minded have been concerned that recently the Boric government, which came into power in 2019, may roll back some of that. But because we invest in the countries that have the higher, the stronger institutions, rule of law, and so forth, their institutions, their checks and balances, and voters have proven a effective check on government power. Every time this new government that's more anti-business has come out and tried to do something, voters have come out in droves to vote it down. And this government, since 2019, has been able to accomplish basically nothing. So that's kind of the benefit of investing in countries that have these strong checks and balances and strong institutions. Poland is similar. It had a government that rolled back a lot of freedoms in the past 8 years. And just last year in October elections, it was a historic turnout, about highest turnout in history. They voted in a more balanced government. And so now the prime minister and the president are from different parties. There's more checks and balances. The EU has come back and approved funding. So they're going to continue, I think, to do well and bullish on these kind of smaller countries like Poland and Chile that don't get a lot of play at all in the cap-weighted indices.
Are the ratings pretty consistent over time? Like, will you sometimes see countries get their act together and like rise up, or does it pretty much stay the same? Like the bad players stay in the bad section, and the other, the higher freedom countries stay in the better part.
Yeah, so we find that increases in freedom are very gradual, and decreases can be faster. So this is why we there are sections. So the top 4 that I just mentioned have always been the top 4. Poland did go from number 1 to number 4 over time. So they were number 1 in 2018. That's before the fund existed, and because that PIS government that came into power and got ruling majority, it did kind of go down in the scoring. But the borderline countries can change from year to year. So these are countries like India, Thailand, Malaysia, Colombia. Sometimes can be in, sometimes can be out. Brazil has also been sometimes in, sometimes out. So yeah, it's a borderline country. Sometimes, because remember the algorithm is taking the above average scoring countries. So if you're around that average score, sometimes you can get switched in and out. We do have a methodology rule that says you have to go below a certain score after you're included to be excluded, just to avoid unnecessary turnover. And then there's also another methodology rule that's a freedom decline momentum rule. So like if you're in the index, but your score declines by a certain number, in that measurement year, then you're kicked out. Like if it's a too quick decline. So that's like a stop loss. The only country that's ever triggered that was Turkey in 2018.
So we just have a couple minutes left, and I just wanted to ask you, we're asking a standard closing question of everybody today, and I wanted to ask it to you. It's, what is one interesting thing you're seeing right now that you think more people should be paying attention to, but are not? And it could be inside or outside investing. It could be anything.
Okay. So I'm seeing a lot of interesting, maybe it's because of my, where we are in the space, but I'm seeing a lot of variations on kind of our strategy, and also other strategies that have non-traditional metrics as part of like the investment strategy. So things like the decarceration index. I don't know if you guys heard of this. This is something new.
No.
What does that
And
mean?
it's like they're looking at companies. They have developed a score that measures companies that have more people that used to be in prison that have come out back into society, and
Sure.
and
Okay.
these
Like
companies
reintegrated into society successfully,
yeah,
reward the companies
re-entry
who do that.
of ex-cons, I guess. So that's something that caught my attention, and I think that the reason why that catches my attention is not only because that's non-traditional, but also because it's kind of different kind of freedom related. But the founder there, Tanae, has a story similar to mine, where she's taking from personal experience and developing something that speaks to that, to the form of expression. So indexing or investment strategy as a form of expression is extremely interesting to me, because I think that we're all expressing a point of view, right? We're all expressing something we believe. And, you don't have to be an ESG investor to do that. Everything you do is an expression of something that is a part of you or your beliefs. So you can do that, even in investment strategies. And as quants, you guys know, like, value guys are diehard, they're expressing something. So I think, investments are a form of expression, and that's something that I'm noticing more and more that people are doing.
I love this so much because there's so many, there's tried and true diehard value bro. And then there's also like the worst form of ESG, which is like the completely like formulaic, like somebody wants to buy no tobacco. Quick, let's make a product and jam it down their throats.
Yeah.
Whereas like and say the word again, decarceration.
Decarceration.
I'm learning a new word today. And yeah, because at first I'm like, what is this? Con Air, the ETF? Like, where is this going? But no, there's beliefs, there's an actual thing behind it. And this isn't a bad thing, especially when we get into capital's a great way to vote.
Yeah. So voting for a form of expression, so yeah, I think, and I do have like a kind of I almost went to art school and have that kind of background as well. So I do think of it as expression. Yeah.
Well, thank you so much for doing this. I've actually now received 2 texts during this interview of how great it is. So thank you so much for spending the time with us. It was awesome. We really appreciate it. Thank you for coming out to support
Absolutely. I
Susan
think
G.
this is
Komen.
the first like phonathon or podathon I've been on. So this is a great concept, and thanks for having me.
Thank you.
Thanks, Perth.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.